Great, guys, let's see what accounting is all about and what are we going to keep ourselves busy with. Well, not only in this semester, but from here on forward. Now, it is very important that you understand what the accounting treatment process is all about. Now, if we aim to see what it is all about, you'll see that there are certain steps that we have to follow. So, step number 1 is transaction initiation. Without a transaction, there can never be an accounting entry. Without a transaction initiated by way of a source document, there can never be a recording of a transaction in your accounting records. Now, once I have a transaction that I want to record in my accounting records, I have to classify that specific transaction in a type of transaction. Is it a cash receipt? Is it a credit sale? What kind of transaction did I enter into? Because that will then determine how I'm going to proceed and account for it. Now, when I'm going to account for it, I'm going to recognize in my accounting records either an asset, a liability, an income, or an expense. Now, we are going to talk quite a lot about these definitions of income, expenses, assets, and liabilities when we do the conceptual framework just a little while later than this slides. Now, each and every transaction should have some value attached to it. So if I have, for instance, a credit sales transaction, there is an invoice involved, my source document. And indicated on the invoice, there is a certain amount associated with that sales transaction. And that will then determine at what value am I going to record that transaction in my books. So step 4 is all about measurement. Now, once I have recorded that transaction in my books, I eventually will prepare something that we call a trial balance. Now, a trial balance is a list of accounts or balances of accounts in my general ledger, and that I am going to use eventually to disclose whatever has happened in the books, in the accounting records of the entity that I'm working with, in the financial statements. Now, if it's income and expenditure, it will be disclosed in the statement of profit or loss and other comprehensive income. Guys, that is what was known by you at school as the income statement. Please note the terminology. We do not talk about income statements anymore. According to IFRS, which is the International Financial Reporting Standards, the correct wording of the income statement is the statement of profit or loss. I cannot make a profit and a loss. It's a profit or loss and other comprehensive income, which we're also going to talk about a lot later on in this course. And we're going to disclose that in the financial statements. So either in the statement of profit or loss or in the statement of financial position. So we do not talk about the balance sheet anymore. The correct name is the statement of financial position as at the end of the financial year. Now, any transaction that the entity enters into needs to be accounted for by following steps 1 to 5. And that is the accounting treatment process, guys. So if we're going to break it down a little bit further and we say number 1, transaction initiation, it means that some good or services were exchanged for some kind of consideration between 2 or more parties. So there's a buyer on the one side or a receiver of the service and a seller on the other side, the seller of the goods or the guy who's performing the service on the other side. Now, all of the parties involved will follow the accounting treatment process, i.e. steps 1 to 5, and then each and every transaction will be recorded in the financial statements as we have said. Step 2 is all about classification. Now, and that is very important, we use the conceptual framework, which we are going to go into detail once we have, well, about 2 lectures from now, and you will have a lot of questions in each and every test or exam on the conceptual framework. So very important, we're using the conceptual framework to see what type of transaction we have entered into, so to classify the transaction. And then we're also going to use, there are certain rules and regulations. When can we recognize an asset, liability, income, or expense, or a combination of that in our financial statements? So IFRS, the International Financial Reporting Standards, or IAS, which is the International Accounting Standards, they will tell you how to identify this transaction, and they will tell you how now step number 3 should take place, the recognition of the transactions. So we say after we've classified what type of transaction it was, and we have now established that we may classify it and we may recognize that transaction, it's going to be recognized in our books. So there will be a certain date associated to the transaction where we're going to recognize that specific transaction in our accounting records. Now again, we said that that recognition criteria and the date of recognition is also specified within the specific IFRS or IAS statement applicable to that. Guys, remember South Africa complies with international financial reporting standards. So we do not do our own thing in this country. We follow international rules and regulations when we do accounting. Right now, measurement, and it seems that there's quite a lot about measurement that we have to keep into consideration. Now, there is initial recognition of a transaction. So that is when a transaction is recognized for the first time. And then there are certain periods after that transaction has been recognized, but going forward, there's some subsequent measurement that needs to take place of the same item. Now, let's take, for instance, we bought vehicles. So it's a non-current asset, not a fixed asset, a non-current asset, and we're going to use that asset, let's say, for argument's sake, for a period of 5 years. Now, what's going to happen? In year 1, at the date that we purchase that vehicle, we're going to recognize the cost price of that vehicle in our accounting records. But subsequent, after that recognition date of when we bought the asset, what do we have to do? Well, on an annual basis, we're going to write off depreciation on that asset. What is depreciation? That is a recognition of the portion of the expense, i.e. the portion of the cost price of the asset that we have used in our trading process, let's say, or our manufacturing process for that specific period. So that means we have to allocate a portion of the original cost price of the asset to the income statement, to the statement of profit or loss, as an expense item, so that we recognize all our expenses which we had to incur in order to make some kind of profits in the current year. Now, the way that we're going to handle that depreciation charge, i.e. what's going to happen after the initial date of purchase of this asset, that was also been described in the applicable IFRS statement. So depending on what kind of asset that I'm talking about, or what kind of initial transaction I'm talking about, there will be an IFRS statement that's going to tell you what's going to happen, not only at the date of purchase or the date of entering into the transaction, but also what's going to happen thereafter. Now, measurement, we said, is all about the value of the transaction, the rand value of the transaction. So obviously it will include some kind of calculation. There could be a tax impact. Now, in your first year, the only tax basically that we do is we do VAT, value added tax, and we do in the second semester a little bit of income tax for companies. But that's the only tax that you're going to do in your first year. However, going further with your studies, you will see that basically everything under the sun that you do has a tax implication, and you will add all the other tax implications as you go along. Good. Now the last one is all about presentation and disclosure of this transaction in our financial statements. Now presentation refers to what financial statement I have to disclose what type of transactions. Is it an income and an expense? It will be disclosed in the statement of profit or loss and other comprehensive income, i.e. our income statement. If it's an asset, liability or equity type of item, that is going to be disclosed in our statement of financial position. In our statement of financial position is the new word for our balance sheet. Now there we have to, again, make a distinction between current assets or liabilities and non-current assets and liabilities. So we all have to have a look, what is the definition criteria of a current asset and a current liability, and a non-current asset and a non-current liability. Now that specific transaction can also be recorded in something that we call the statement of changes in equity. Now look at the abbreviation. Now equity per se means it's got something to do with the owners of the entity. So whenever the owners of the entity has made a further capital contribution to the entity, that will be reflected in the statement of changes in equity. The profits that the equity is going to make, to who does those profits belong to? That belongs to the owners of that entity. So that will also be disclosed in the statement of changes in equity. All kinds of distributions that the entity is going to make to its holders, to the owners. Now, if it's a company, the distribution that's going to make will be a dividend. If it's a one-man show, so it is a sole proprietor type of business, then the distribution that's going to be made will be as part of my withdrawals to the owner of the entity. And then the other one, the last one, is our statement of cash flow. Now we're going to do in our second semester, we're going to do cash flow statements. That's IS 7. And there you will see that we have operating activities, investment activities, and financing activities. Now disclosure, we say that's presentation. What is disclosure all about? Now disclosure is all about the notes to the financial statements. We don't want to clutter these financial statements with too much information. So we said we'd rather keep that as slim and trim as possible. And if we need to explain something further to the users of the financial statements, we are going to put it in a note to that specific line item in the financial statement, where we will describe to the user exactly what that item was all about. So that way of disclosing certain items, I again cannot follow my own thinking. I cannot only follow what I would like to see there. That is also prescribed by our IFRS and IAS statements, and we have to follow that very, very rigorously. So, again, if we can then summarize, step 1 is transaction initiation. Then we have a buyer versus seller, and we exchange goods or services for some kind of consideration. Step 2, classification. How do we classify that transaction? As what? What do we use in this classification process? Very, very important, the conceptual framework. And we are going to look at IFRS and IAS to give us some guidance. Step 3 is all about recognition. That is, when are we going to recognize the transaction? At what date are we going to recognize the transaction? And again, we're going to let us be led by the applicable IFRS or IAS statement. And then step 4 is all about measurement. So at what amount are we going to initially record this transaction? What are we going to do with this transaction? If anything, we don't have to do something with that specific transaction afterwards. If we have paid our telephone bill, what do we want to do after we've paid the bill? Nothing. So that will only have the initial transaction when we pay the bill. So subsequent, in that case, there will be no additional transactions. But like the example that we've used of purchasing a non-current asset and we have to depreciate it over the lifetime of the asset, there will be subsequent entries based on the initial transaction that we've entered to. And then we will have to follow, again, the specific IFRS or IAS statements to help us to see how we have to do that. And the final step then is presentation and disclosure. Where in the financial statements are we going to disclose this transaction? Is it in the statement of profit or loss and other comprehensive income? Is it going to be in the statement of financial position, statement of changes in equity, or statement of cash flow? Or is that transaction going to appear in more than one of these statements? Very probably it's going to appear in more than one of these statements. And then what is the impact on the notes to the financial statements? And again, we're going to be led by the IFRS or the IAS statement applicable to that transaction. So I trust that you know now what the accounting process is all about, because if you don't understand the accounting process, you don't know what you're busy with. And if you don't know what you're busy with, you might as well stop right here and there, because you're going to lose me as we go along.